Hello and welcome to DIY Investing. Today we are covering International Paper, ticker IP. Over the next few minutes, I'll discuss my thoughts on both valuation of this company and its business quality. First up, we can see the market cap is $11.7 billion and enterprise value is $16.6 billion. So you see about $5 billion in net debt on this business, which is actually an extremely large amount. That's about a third of the overall enterprise value. So highly leveraged. They're operating in the containers and packaging industry. So IP produces renewable fiber-based packaging and pulp products in North America, Latin America, Europe, North Africa. Renewable fiber-based. Is this just cardboard? Segments manufacture container boards, liner board, medium, white top, liner board, recycled, craft. It contains fluff, market, pulps. It's paper. Okay, so they produce paper products, packaging, containers, things like that. Now, for return on invested capital, this is like a perfect chart for what I would call an average company. Let's count how many years they have a loss. It's 1, 2, 3. So they have 3 years of losses in the last 22 years. So you see losses in 2001, 2004, and 2008. Basically, they're losing money during recessions. 2020 was a recession. They managed to make a profit during 2020, but they do experience big downturns and recessions. And you just see very cyclical numbers here. You're going up and down. 4% returns here, 7%, 4%, 7%, 3%, and you're bouncing around a lot. That unpredictability from year to year is the pinnacle of where I would say is kind of an unpredictable company, but would certainly be average, and you're bouncing around between 0 and 10% return on invested capital. When you want to get above average, you really need to start getting above that 10% return on invested capital range, and you can see that they're not doing that. Over the last 10 years, they're averaging right around 6% return on invested capital. That makes a lot of sense based on what we're seeing here. Now, on a return on equity basis, they hit 19%, which is very good. I want to see how that is across most years. And you can see across most years, they are well above 15%, which is what I want to see from a return on equity basis. So return on equity, they're doing quite well, even though they have return on invested capital. How do they do that? Well, it's clearly this leverage. All of this debt is allowing them to leverage up these 6% return on invested capital numbers to push up the return on equity. However, I have concerns with current high interest rates because high interest rates would damper this a little bit. If you can leverage up at low interest rates, you can get interest rates at 2, 3, 4% return on invested capital. You get that below the return on invested capital, then all of the bonus there goes to equity holders. But once interest rates go above 6%, now all that debt becomes a big weight on the overall business. And so I have some major concerns that this is really a zero interest rate phenomena where they can do very well. And of course, the interest rates used to be much higher back in this 2000 to 2004 timeframe. So you can see that they did a lot worse back then. Major concerns on the overall business viability of getting good returns with that. Now, valuations look quite cheap. PE of 11, price to book of 1.4, price to sale of 0.6. So if they can pull off something here, you're not paying a super high starting price. Let's look at the profits and compare that. So what are our profits and what is our price? So we've got $34 here. So $4 per share. So on 2020 numbers, they're trading at like less than that, 8.5 times earnings. So in order for them to be at 11 times earnings, it's saying current earnings are a little lower. But you can see the bouncing around: $3, $1, $2, $2, $5, $4, $3. So they're not at peak numbers. They're down from peak numbers. And only a few years ago, they were down at $1. Very unpredictable. Now, they are paying a dividend. Even the dividend has come down over the last 2 years. So it's not like it's a predictable, reliable dividend. These revenue numbers are instructive. Declining revenue, negative 0.3%, basically flat. So they started the decade at $23 billion, end at $21 billion. This is not a growing business. Without growth, it's really hard to justify being a long-term shareholder of any business that's not growing, let alone one that has poor returns. So for that reason, would be almost an instant pass for me, but we might be able to learn a little bit more. You can also see gross profit has declined by 20%, $7.2 billion to $6 billion. That's not great. Operating profit, $2 billion to $1.7 billion. So again, 20% decline. So they show EPS being slightly higher, but that's bouncing around all over the place. So again, very average company, what I'm seeing here. If you're learning something from this video, if you like this video, hit that like button. Don't forget to subscribe. Let's see what else we can learn here. So SG&A has gone down 10%, 3.3 to 3 billion. That's good. If you're suffering from reducing your gross profit, you need to reduce your operating expenses, and they are doing that. That's a good sign. It's one of the things that's important to prevent them from going under. You see 448 million shares outstanding down to 367. So they've been able to pull off 15 to 20% of their shares outstanding over the course of a decade. That's going to add a 1 to 2% boost to your EPS per year because of that buyback. So I like that I see that there. Let's go to the balance sheet. We see PP&E here was 14 billion down to 10 billion. So they've pulled a little bit of the assets. Assets coming down. That's a good sign. Liabilities coming down. Long-term debt here, 4.8 million. They used to have a lot more debt, so they've been paying down their debt. That's actually good. But man, it's probably taking all of their money going towards this. Let's go to cash flow. You can see they're having to reinvest about $1 billion a year in PP&E. How much are they making? Around $1 billion, not a lot. So they're putting a lot of money back into it. So that's, of course, matching with its depreciation numbers. This should tell you these are real depreciation numbers. This is real depreciation. It's not a fake expense. You shouldn't use this cash flow from operations number if the depreciation is real, in the sense that you need to replace this equipment. You're having to put a lot of money back into the company there. They've been trying to pay down their debt with a large amount of money. But it's very expensive. To me here, you see the dividends, stock buybacks. Where I get stuck on this, it's not that the capital allocation's poor. It's not. They're making smart decisions. They're paying down their debt. They're reducing their risk. The capital returns are just too low. It's really hard to get strong double-digit returns as a shareholder, 10% returns as a shareholder, if your return on invested capital is 6%. It's just too low. You want sustainable double-digit returns on invested capital in your business if you want double-digit returns as a shareholder, and that's what I want, 10% plus, 12% plus, 15% plus. If I want to hit those numbers, I need to hit those numbers on my return on invested capital line. Now, you can use leverage to get higher return on equity, but that comes with a lot of risk. And so I'm not opposed to leverage, but I still want my return on invested capital to hit that 10% number. And then even if that was true, even if all these numbers were above 10%, you're bouncing all over the place. It's very unpredictable. The more unpredictable the returns are to the business, the harder it is to manage, the harder it is to compound your money over time. So for that reason, I'm passing on international paper. It's not going to hit my watch list today. If you learned something, hit that like button. Don't forget to subscribe. And if you want to see these companies that do hit my watch list, check out the playlist that's going to show up here for the companies that hit that list. And if you want to learn how to look at some software companies, use some software to do that, quick 10-minute reviews, quickfs.net is the one I recommend. My affiliate link is the first link in the description below. Please consider using my link. You can get a free or paid account, but using my link is a great way to support the channel, because then I can get a commission when you sign up, free or paid. Same price as if you did otherwise, but it's a great way to support me. So thank you for listening, and until next time, stop paying fees, start building wealth.